Now let's move on to the next chart. I'm going to show you our risk and reward. In April of 2011, the market was moving up and kept moving up, and our stocks kept hitting the sell point. We kept selling, and we ended up with about 30% in cash. The risk and reward on the market, remember in Cisco was 3.5 to 1, got actually as low as 1.38 to 1. So we were kept selling, and then all of a sudden, out of the clear blue, this market went from 1366 to 1099 in a matter of months, and our risk and reward went from 1.38 to 8.95. Now, we knew at 8.95, it's not going to stay there that good because 3.5 to 1 and 4.5 to 1 and 5 to 1 are great values. And it didn't stay there very long. I think it was only about a week. And then it took off, and now we are at August of 31st. We are back to 28% cash, where risk and reward is 2.25. And I think if it went up another 10%, we would be at the 1.38 times risk and reward, which is not a very favorable reward. So if you look at the chart, if you looked at that other chart, you can see that the big cap stocks are way ahead of the market, and so that's why they have a little bit more risk than some of the other smaller cap companies. But what our strategy is going to be during these times, when we get up to those levels where the reward and risk is not very favorable and our stocks are hitting the sell point, and as you can see, we got very conservative sell points, we're going to be selling them out. Some of these companies we'd love to own for the long time, but we're going to sell them out and keep the cash because there's plenty of problems that will unnerve this market in the future, and those are the problems we talked about.